Okay, so again, the allowance method, I think we've already talked about a lot of this. Um, the allowance method is going to be adhering to the matching principle. That's the whole reason why we're doing it. We don't know ahead of time who's not going to pay us and how much. Okay, so we're going to have some generic way to deal with this. Okay, because we can't say in the last example we knew that guy Dan King is not paying us, but when we are at the end of the year, we have a bunch of accounts receivable with a bunch of different customers. We don't know ahead of time who's going to not pay us. Okay, so essentially what we're going to do is we're going to set up a little piggy bank account, and then as actual customers stop paying us, we kind of draw down that piggy bank. Okay, so that's kind of what we're going to be implementing. So again, yeah, the problem is we don't know which customers and how much we're going to not be able to collect. So the solution is we set up this piggy bank. It's called Allowance for Bad Debts. Okay, that's the name of our piggy bank account. That's going to be kind of where we're going to set up this fund for all the receivables that we're estimating we're not going to collect. It's a contra account. It's paired with accounts receivable. And then in the future periods when we actually have accounts receivable go bad, we're going to reduce that piggy bank. Okay, and I'll show you how that's done with the journal entries in a second. But just think about uh, the concept of a piggy bank that we're setting up at the end of the period. It's meant for drawing down when we actually have accounts receivable to set up. We've already taken the expense. We've already factored it in to the financial statements for that previous period. And then as things go bad, we can then just draw down the piggy bank instead of having to take an expense every time. Okay, so we're basically taking the expense up front, setting up the piggy bank, and then drawing that down. There's a problem with this system. The piggy bank is not going to be set up exactly for how much we actually have to write off. Because again, it's based on an estimate. The piggy bank is set up based on a estimating methodology, and it's not going to be correct. We're going to either overestimate or underestimate. Okay, so at some point we're going to have to true it up. We're going to have to true up how much we actually expense as an estimate with what actually happened. But we're not going to be able to do that until the future kind of plays out. Okay, so the system again has its significant drawback, and a company can also play a lot of games with these estimates. I think I mentioned, another estimate that is used is for warranties, where you don't know exactly how many people are going to come back and use a warranty. So Tesla was like notorious for basically selling way more cars, but they didn't really increase their estimate for warranties. Okay, so that's one way that they were they underestimating or overestimating how much warranty expense they're going to have in that case? Underestimating, right? So they're going to later have to take a much bigger expense. Okay, but they did that to boost their net income in the short term, because if you're underestimating the warranty expense, it's going to make your net income higher, right? So companies can do this a lot. They can insurance companies. They're doing a lot of estimations on how many losses they're going to have, like in a given year, and so they can also really play games with these estimates. Okay, so the estimates are not perfect, and a company can really game the system to their advantage, or to like deceive in a deceptive way if they wanted to. Okay, so this is kind of how it works. At the end of the year, our accounting department estimates that $1,000 of accounts receivable should be expensed as bad debt. And again, how this $1,000 came about, we're going to talk about. There's those three methods, right? But for now, just assume that this $1,000 is there. Okay. So what you'll do as an adjusting entry, just like every adjusting entry, it's at the end of the period. You're going to take this expense, $1,000, and you're going to set up this piggy bank called Allowance for Bad Debt. Okay, this is a contra asset account. It's paired together with accounts receivable. Okay, so now this bad debt expense is going to appear in the income statement for this same period. as the revenue. Okay, so let's just make sure we're clear about this. So in the balance sheet, let's say we had $15,000 of account receivable. We just set up this allowance for bad debt of 1,000. Okay, this is our piggy bank. This is the gross amount of account receivable, but we're not going to be able to collect all of it because we're estimating that some of these people are not going to pay us, right? So what we're going to do on our balance sheet is only record the net value because we have this debit balance and we have this piggy bank set up for those $1,000 worth of account receivable. We don't know exactly who is not going to pay us, but we've already kind of accounted for it up front. So on our balance sheet, we're only going to report 14,000 because really that's what we think we're actually going to collect, right? Though we have 15,000 gross, we're already presupposing that 1,000 is going to go bad and we're not going to collect it. So on our balance sheet, we want to show only what we think it's actually worth. It's not worth 15 because we know we're not going to collect all of that. So we're going to report this net balance, which is the gross less this contra credit balance. So now we have this piggy bank set up. We have at the end of the year, this is what we're going to report for account receivable. And on the income statement, we're going to have this $1,000 debit. And so the income statement is going to look something like this. Sales revenue, 15,000, cost of goods sold. And this other expense, this is where this is coming from. So this net income is assuming, because this 15,000 was from credit sales, that's where kind of this came from. But this 1,000 is already kind of assuming that 15,000, some of it is going to be like not correct, okay? Or like it's not going to materialize. So this net income is now cleaner, right? We now have accounted for some of those credit sales not being collectible. Does everyone agree with that? Okay, so now let's do the next thing. Okay, so now we have these 14,000, this 15,000 in accounts receivable. Now we're like, someone is not going to pay us. This customer, Wilson, is not paying us $500. So think about, what is a journal entry now? What should we do? See if you can figure this out yourself. And then think about what happens to the account receivable. Assume this is like the first transaction of the year. Okay, there's been no credit sales. Our balances are still this, it's not realistic, but just assume that this is our balance for account receivable. This is our allowance for bad debt. And of course, since it's the new year, this goes to zero. Okay, this is a temporary account. So think about what the journal entry should be. And again, we're using the allowance method now. Are we going to take bad debt expense? How about that? Let's start with that question. Who thinks that bad debt expense is going to be part of this transaction? Raise your hand if you think is yes. Raise your hand if you think no. Okay, good. Yes. We're not going to take bad debt expense. We already did. We already, in this instance, already assumed that some of these account receivable are going to go bad. We already took the expense. So when it actually happens, we don't have to take that expense again. We pre-took that expense. Okay, so now we kind of have this piggy bank of $1,000 that we can take the actual bad debt when it actually happens. We can use this piggy bank. Okay, so what we'll do is we're basically gonna have to reduce the account receivable. Okay, so let's just look at it here. So we're gonna debit allowance for bad debt, and we're gonna credit account receivable Wilson. Okay, so what that's gonna do to our account balances is we had this account receivable, which included all of our subsidiary accounts, right? Wilson was in here. Wilson, Davis, whatever. You had all these different people. They all constituted this. Now we're getting rid of Wilson. So we're going to credit account receivable 500. And we're going to debit our piggy bank allowance for bad debt 500. So this is going to get reduced. This is also going to get reduced. Okay. The net has not been changed, right? We have a for 14,500 debit balance here and a $500 credit balance. The net amount is unchanged. Now, does that make sense? It makes sense, right? Because again, back at this moment when we took the adjusting entry, we knew that some of this was going to go bad, right? We already reduced it here. So when things actually play out the way we thought, it's like not unexpected. It's already baked into here. So yes, this makes sense because we just drew down on this piggy bank. We already set up losses of $1,000. So now we're actually using that piggy bank. So of course, this could be a problem. Like let's say we had another write-off for, let's say there's another write-off for $1,000. Okay, so now we would have to credit 1,000 again here, some other customer, and we'd have $1,000 here. So now this is going to be 13,500, and this is actually going to turn into a debit balance, 500. Okay, so this is wrong. We can't have this allowance for bad debt contra account ever go into debit, because now what is this? It's still going to be 14,000, right? Now we have debit balance, right? But that's wrong because we've actually overspent our piggy bank. So we'll have to do something. We'll have to fix that. So how about this? Let's say this was the only write-off that happened this year, okay? And this $500 write-off. Okay, so now these are our balances at the end of the year, right? So now we're going to do another estimate. We're going to say of this 14,500, maybe we expect $500 of that to be uncollectible. Yeah, again of the year. And actually, we wouldn't have to do any. If we thought that of this 14,500, 500 is uncollectible, we already have the piggy bank set up here. Okay. What if we thought that $1,000 is going to be uncollectible? Then we're going to have to do an adjustment. We're going to have to make 500 here and take bad debt expense 500 as an adjusting entry. But we're going to true up. We're going to add to this allowance for bad debt only at the end of the year. We're going to see what the balance is at the end of the year. And then we're going to do an adjusting entry based on that ending balance. You're going to assume that I need whatever, $1,300 here, right? I'm going to assume that this is the balance I need in allowance for bad debt based on my estimates. So what would my adjusting entry be? If this was my ending balance unadjusted, I want this to be my adjusted balance. What do I need to do? You need 800 credit. And so that would mean that I would take a bad debt expense 800, credit allowance for bad debt 800. And then that would give me this piggy bank at the end of the year. And then I would have some other write-offs. Maybe I would have $1,500 of write-offs. And then I'd just keep updating this allowance for bad debt based on what the ending balance was.